Quick disclaimer. Before we begin, this video is for educational purposes only. It is not financial advice. Always do your own research or speak with a qualified professional before making investment decisions. Dividend versus growth investing in Canada, beginner guide. Should you focus on dividends or growth? If you're a beginner investor in Canada, this is one of the first big questions you'll face. And the truth is, most people misunderstand the difference. Today, we're going to break it down in simple terms. No hype, no predictions, just clear education so you can decide what fits your goals. What is dividend investing? Let's start with dividend investing. A dividend is a payment a company makes to its shareholders. If you own shares of a company that pays dividends, you receive cash, usually every quarter. In Canada, many well-known companies pay dividends. For example, banks like Royal Bank or TD, utilities, telecom companies, energy companies. Dividend investing means you focus on buying companies that regularly share profits with investors. You're investing for income, not just price growth, but cash flow. Some investors like dividends because they create regular income. They feel tangible and predictable. They can be reinvested to buy more shares. It can feel rewarding to see money deposited into your account regularly. But dividends are only part of the picture. What is growth investing? Now let's talk about growth investing. Growth companies usually reinvest their profits back into the business. Instead of paying shareholders cash, they use profits to expand, innovate, and grow. Think technology companies, or newer companies expanding rapidly. Growth investing focuses on one main thing: increasing share price over time. You don't get regular income payments. Instead, you hope the company becomes more valuable. If the business grows successfully, the stock price rises. You benefit when you eventually sell your shares. Growth investors are investing for appreciation, not income. Understanding total return, the most important concept. Here's where beginners often get confused. Dividend versus growth sounds like an either-or decision. But investing performance is measured by something called total return. Total return equals price growth plus dividends. If a stock goes up 8% in a year and pays a 4% dividend, your total return is 12%. Even if a company pays no dividend, if the stock rises 12%, the total return is still 12%. Dividends are not extra money. They are part of total return. That's important. Because some investors focus only on yield and forget about overall growth. What matters long-term is total return, not just income. Advantages of dividend investing. Let's look at the potential benefits. 1. Regular income. You receive cash payments. This can feel stable and reassuring, especially if you're building income for retirement. 2. Psychological comfort. Seeing dividends arrive can make market volatility easier to handle. You feel like you're getting paid to hold your investments. 3. Useful for income goals. If your goal is to live off investments one day, dividends can play a role. Now the trade-offs. 1. Slower growth potential. High dividend companies are often mature businesses. They may grow more slowly. 2. Yield chasing risk. Some investors chase very high yields, but high yield can sometimes signal trouble. If a dividend is unsustainable, it can be cut. 3. Overconcentration. Many Canadian dividend investors load up on banks and energy. That can reduce diversification. Advantages of growth investing. Now let's look at growth. 1. Higher growth potential. Growing companies can increase in value significantly over long periods. 2. Tax efficiency inside taxable accounts. Because you don't receive regular payouts, you may defer taxes until you sell. Inside registered accounts, this matters less. We'll get to that. 3. Compounding power. Reinvested profits stay inside the company automatically. That can accelerate long-term growth. Disadvantages of growth investing. But growth has trade-offs too. 1. More volatility. Growth stocks can move up and down more dramatically. 2. No income. If you need cash flow, growth stocks don't provide it. You would need to sell shares. 3. Emotional pressure. When prices drop sharply, it can test your discipline. Dividend versus growth inside a TFSA and RRSP. Now let's talk about account types in Canada. In a TFSA, tax-free savings account, both dividends and capital gains grow tax-free. If you earn dividends, you don't pay tax on them. If your investments grow in price, you don't pay tax when you sell. Inside an RRSP, Registered Retirement Savings Plan, your investments also grow tax-deferred. Dividends and growth compound inside the account. You pay tax later when withdrawing in retirement. At a high level, both dividend and growth strategies can work inside either account. The account type does not automatically make one strategy better. Your overall financial plan matters more than the dividend versus growth label. Example scenarios. Let's make this practical. Scenario 1. Young investor. You're 25 years old. Stable income. Investing for retirement 30 plus years away. Growth may appeal to you. You don't need income today. You want long-term compounding. Volatility may be easier to tolerate. Scenario 2. Income-focused investor. You're 60, planning retirement soon. You want predictable cash flow. Dividend-paying investments may feel more aligned with your goals. Regular payments can support spending needs. Scenario 3. Long-term builder. You're 40. You want growth now, but eventually income later. You might combine both approaches. Some dividend exposure, some growth exposure. Remember, this is not either or. Many diversified ETFs already include both types of companies. Common beginner mistakes. Let's talk about mistakes to avoid. 1. Chasing high yield. A 10% dividend sounds attractive, but ask why it's that high. Is it sustainable? 2. Ignoring total return. Don't focus only on income. Look at overall performance. 3. Lack of diversification. Don't concentrate only in one sector. Canada's market is heavy in banks and energy. Global diversification matters. 4. Emotional investing. Switching strategies every year hurts long-term results. Consistency matters more than picking a perfect style. Final thoughts. So, dividend or growth? There is no universal winner, only what fits your situation. Focus on total return. Focus on discipline. Focus on long-term thinking. That's what builds wealth over time. Soft CTA. If you found this helpful, you might also enjoy our beginner guides on Canadian ETFs and dividend investing basics. Those videos break down simple portfolio approaches step by step. Thanks for watching, and I'll see you in the next one.